Let's go. Let's go.
Hey everyone, welcome to another episode of Vyzer Weekly. I'm excited to kick this off today. A really special guest. We got Scott here, and we'll talk about that in a second. Housekeeping wise, as usual, this is an open conversation. Sort of, you guys see each other, we see you. If you have any questions, any feedback, anything you want to talk about or dive into, write in the chat, unmute yourself and ask. This is an open conversation. We're going to share the recording afterward as well. And so if you have to drop off, don't worry about it. You can have this recorded. Um, we're going to try to go 45 minutes, but if we need to go over, we have, a couple minutes to go over. And yeah, let's just dive into it. So Scott Trench, very known human being in our industry. I'm going to let you introduce yourself in a second, but I'm super excited to have you join us here today. Uh, and why don't you just give us like a quick background of you for those who are less familiar, maybe, and then we'll dive into it.
Sure, yeah. I'm the former CEO of BiggerPockets. I joined BiggerPockets back in 2014 as a fan of the website and a broke recent college graduate and wanted to invest in real estate. So I actually bought duplexes and house hacked and those types of things and kind of grew up alongside the business, which exploded from about 100,000 members when I joined as the then third employee to over 3 million members by the time I stepped down as CEO 10 years, 11 years later. So wild, wild ride there. We sold the business twice to two different private equity firms, one in 2018 on behalf of the founder and one on behalf of the private equity firm in 2024. So that was a wonderful experience there and kind of got to see everything from the startup phase to the scaling growth company phase. On the side, I built my real estate portfolio to about 20, 23 units across seven structures here in the Denver, Colorado area. I've invested in a couple of syndicated real estate investment deals and lost my lunch money pretty badly since, especially the ones that I invested in 2020, 2021, 2022. I don't know if anybody else shares that experience set. And I've been very cautious with that since. So most of my portfolio is actually directly controlled with a tiny slice in these syndicated opportunities. And the idea that I was thinking I would talk about today, but this can go wherever you guys want. It's a small group, so questions or whatever can certainly change the course of this and turn it into more of a Q&A. But I thought basically there was the idea that I would try to get across is I think a lot of passive investors react to whatever comes across their desk. And that was what got me a couple years ago and why I lost a lot of money. And I think that what I would push you to do is have a thesis, create a fictional perfect investment, and then attempt to find that and go outbound into those areas. And so I thought I would present one, maybe two theses of that type. They may be terrible. You can decide that for yourself on this front, but I would kind of give you an idea of what that might look like here. One would be in the debt side, and one would be in the office side. And I try to kind of breeze through those pretty quickly, although they are fairly complex. I think to form a good thesis, there is a layer of complexity and depth of understanding you need to have in that. So that's the idea. What do you guys think of that? Is that does that sound like a good topic for today? I'd be
Yeah,
interested.
I'd love to hear people's thoughts around that. And I think it's really important what you mentioned, Scott, because so many people react and make decisions without even thinking about why they're making those decisions, either to have like a goal set or a thesis that they're going, out to achieve or to prove. And so I love that. When we had our call a couple days ago, I thought it'd be really interesting to hear like on a high level before diving into like the tactical thesis. Like, what do you think strategically when you think about a portfolio needs to be achieved, or people need to think about it in which context they're in? Obviously, we also talked about this. Each person in their own specific financial situation and their own persona, where we put them in a box. Like before diving into the specific thesis, debt, office, real, whatever it is. Like, if you take it like 30,000 foot above, how would you think about people? How should people think about even putting together a thesis? Does that make sense? Like,
Yeah, I think I like this is what we obsess over all day long at Bigger Pockets Money, right? And it's the same problem for a 23-year-old kid deciding what they need to do with their next car purchase through to a decamillionaire that's thinking about selling their business and how to deploy the proceeds from it. or how to make the next capital allocation with their business or position it for sale, and all the way through to the high income earning professional. And I think that the way I'd answer your question is it starts with a definition of a goal. It's very simple and very hard. Is there a clear definition of winning? This can be a vision. That's the literal artifact that we, set out as one example of what that looks like. But here's what my day looks like. Here's what I do with my time, and here's exactly what I want. And then is the portfolio being engineered to accomplish that goal? And there's a lot of different right answers to that. I think that what we're learning over the last couple of years at BiggerPockets Money specifically is that there's a lot of I don't know what the right word is, religion around the right ways to invest and build portfolios. And in practice, there's so many different variants that achieve success across that dynamic. Broadly speaking, however, I would say that at a high level, people who are just starting out on that journey need to be very aggressive with their wealth building. People who are approaching some version of their target that they wanted, that they set, that vision that they're looking for need to begin to back off and become more conservative. And then as you blow past that number, which happens to many, many people, then you can get aggressive again all of a sudden, as long as you don't do anything particularly silly. And so that's kind of the framework here. I wonder if a lot of people on this call are either very close to their target and need to consider how to back off or diversify to actually develop a portfolio that gives them what they want, or they maybe be starting to blow past that and can kind of get aggressive again in the context of a reasonably diversified portfolio. So I don't know if that answers your question, but that's broadly how I think about it. I think you're muted.
When you think about sort of aggressive versus less aggressive, in the most layman terms, it's usually in portfolio theory, it's like the 60-40, 70-30 between equity and debt, right? And that's how you define the debt is like the more stable, the equity is the more dangerous. And that's how, the basic level of thinking about portfolios, right? And then I always like to add, there's another layer on top of that, which is okay, you have equity, you have debt, and then you have privates and publics. Like they all have their different uh, um, risk and liquidity and cash flow and all sorts of other stuffs in the privates and publics. And so as you become more sophisticated, if at the beginning you're just publics, right? You're splitting between public equities and public debt, then you start to add privates into that mix. And then within the privates, which is what we're going to talk about, you can add different private asset categories. Can be debt, could be equity, right? But it's the private we're talking about, and obviously this conversation is going to be mainly around real estate. But when you think about your thesis and how you allocate your portfolio, you don't have to go in like numbers, but do you think about it in a similar manner where, all right, you have your equities, you have your debt, and then you have the privates in both of them, and then you want to allocate to real estate? Do you think about it in the same type of manner where you want real estate in the private debt, you also want real estate in the private equity, or you think about it in a different structure?
90% of my portfolio is privately held, owned and operated real estate and stocks, traditional investments in public equities. And I think in the private markets, and this might be heresy, this might be the wrong group to say it, I think you're going to lose to those two investments over very long periods of time unless you're a true expert because it's so much more expensive to invest in these areas after fees. So that's why I think you've really got to have a specific thesis or get something different out of these investments if you're going to win in the context, whatever that means for you, in this world, the wild west of syndicated or private equity, real estate, and other asset classes. I think it's going to underperform the public markets over very long periods of time from a total return perspective, and it may produce less or different cash flow than directly owned and operated real estate. Although that's a part-time job. That comes along with that. So
Yeah.
I'll say that I'll state that frankly.
Okay, let's dive into your thesis around sort of within the private space, within real estate. You have a thesis around debt, right?
Sure. So so just to frame this, right, there's two ways to invest in real estate, right? You can invest in the debt side or the equity side. And there's obviously hybrids in the pref world or mezzanine that all operate the same way. It's basically second position debt here. Um, I know you guys have talked recently to Layla, is that right?
Yep. Yep.
I think she's fantastic, and I think that broadly speaking, her positions on the risk profile in the private debt markets is spot on, and that this is a highly risky area to invest in. It also provides different. exposure to real estate than what you can get on the equity side. So I thought I'd explain an example of a private equity real estate credit fund looks like in the context of what was my bread and butter at BiggerPockets, right? So at BiggerPockets, we didn't really deal much with these big time office investments or large scale apartment complexes. Those were there, but the real bread and butter was single family, duplex, triplex, quadplex, small kind of achievable investments for median to upper middle class income earners to take down. And so in that context, what a lot of these investors will use is they'll use a debt product called hard money. Does anyone here heard of hard money before? Great. So hard money, when do you use hard money? You use a hard money loan to fix and flip a property. And that means that you can't get this 3 or 4 or 5 or 6, now 6 or 7% interest rate loan on the product. So you have to go to somebody that's willing to lend on a property that's going to be in transition, that's not lendable right now by anybody else. The people that are doing these flips are not like professional, seasoned, experienced professionals with tons of team members, right? They're not desperate for money, but they're willing to pay a very significant amount of interest and serious points on these loans in order to get access to the financing, right? And a good outcome for this person might look like taking down a $400,000 or $500,000 property in an area like Denver that needs a ton of work, putting 150 to $200,000 into it and selling it in the ballpark of $1 million and attempting to make that two or $300,000 spread. So that's what the flipper is trying to do. They're bringing 150 to $200,000 down, and they're often personally guaranteeing this debt on this hard money loan to the lender, right? The lender is going to maybe lend, let's call it $500,000 or $600,000 on this example project, and they're going to charge 2 points. So a $600,000 loan would generate $12,000 in profit for the loan originator. What happens next is they put that loan, this fix and flip loan, into a debt fund, right? That they usually own and operate. They can also sell that loan to somebody else who will put it into their debt fund, right? So this is the unit economic of one of these hard money loans, these hard money debt funds that I'm about to talk about here. And that loan is going to charge anywhere from 10 to 16% interest, right? And that's very attractive, right? So let's say you pull together 100 of these loans, you have a $50 million debt fund, right? That debt fund is going to have 25 million, it's called $20 million in a bank loan, right? They're going to go to Chase Bank or something like that and get 6, 7% interest debt, something SOFR plus a few hundred basis points. And then they're going to get equity from people like you for the remaining portion of that fund, right? And so that means you can get a leveraged return in the upper teens on this type of lending. Is this going too fast? I'm assuming this is a
So
pretty advanced
yeah,
audience.
I think it's good, but I just want to sort of like organize it again for me, just to clarify that we're on the same page, right? So you have the
Sure.
operator. The operator is the person who's flipping the home, right? And
Yes,
that person now needs a loan. And then there's a hard money lender, right? Just one person who's lending that flipper money, right? And then
you got it.
that hard money lender might want to do multiple flips, like lend money to multiple flippers at the same time. So that hard money lender might need external money to be able to lend to the flippers that hard money lender knows, right?
You got it. Yep.
And and then a hard money lender might also get equity from investors like us, but he also might go and get money from the bank, which is what you're calling a leveraged hard money lender, right?
That's
And that
right.
hard money
Yep.
lender becomes, and that's the fund you're talking about. So just to clarify where we're at.
Exactly. So this is different from like like a BDC fund or something. The risks in this space are absolutely exposed to the things that Layla would have talked about on a recent call here. Perhaps much more eloquently than I will be able to talk about them. But this is a slightly different risk profile than what you're used to hearing about in this debt fund space. And I want to talk about this. And I'm not like a champion of debt fund investing necessarily. I do have about 100 grand in a debt fund that's local here in Colorado, and I will deploy a little bit more to that, which is a small piece of my portfolio. But it is not a core part of my thesis here, and there are real risks to it. So I wanted to attempt to present this as it is, and then share what a good thesis might look like for exploring this space, rather than recommending any specific funds or anything like that. on there.
And I
So
also, and I want to add also one more thing because Mike and I talk about this a lot. Like this is like we're not talking about the DLPs of the world or the BH3s or the Lone Stars that are like the big
yeah,
debt
that's right.
funds, or they're not the huge one like the Blue Owls, but they're sort of like mid to large. This is like underneath them. That's what we're focusing on this.
Yes, these are private operators that you're gonna have to call and go outbound to, most likely. You're not gonna get these guys. These guys are not marketing to you on in here. You're gonna have to go outbound to these people, look them up, get their prospectus. They don't need your money necessarily. They'll take it certainly because that'll allow them to originate the next loan. But these are not the big boys. They're kind of in that sweet spot of like, hey, there's real returns to be had in this space, and there's real risk in here. And how do you mitigate and manage that in the debt fund space? And basically, why I'm interested in this and why I think I might be a unique resource on this is because these people sponsored the BiggerPockets Money website for many years. We had 100, 200 people of these folks. They were trying to market for flippers, right? They wanted people to borrow. They wanted people to lend to. They wanted borrowers for these projects. And so when I was researching this, I literally called up every single one of these several hundred hard money lenders across the country, and I got a real spectrum of experiences in these phone calls from people who had no business, who should have had no business running any type of fund, managing other people's money, to really professional operators who, were very passionate about the projects that they were in and had deep experience as flippers in there. And that's what makes this fun, right? You guys are chasing yield or risk-adjusted returns. They're here in this space, and there's real problems as well
Yeah.
there. So that's the
Do
fun
you want
part.
to
So
show us
yeah,
something?
yeah, I'll flip through this real quick. First, like I said, there's no free lunch. This is the wild west of private credit. You're going to see a whole spectrum of different opportunities across the space. The kind of idea here, the going in instinct is you should be looking at funds, or the funds that you would invest with are going to promise there's an opportunity to potentially get this kind of 8% pref, a passive monthly paycheck. There is physical real estate backing these, and there's often upside on top of that pref, right? A typical structure might look like an 8 pref. The next 2%, 200 basis points go to the fund manager, and then there's like a 70-30 split would be a very common type of structure in this debt fund category here. And that could yield, 10, 11, 12%, depending on how things go. It's all simple interest. So that's one thing to consider. This is not a good option if you're an airline pilot or a doctor to do in your after-tax brokerage account or with your after-tax dollars, because it'll be very tax disadvantaged. But it could be very interesting if you have a big solo 401k. I also think that like a self-directed HSA is a really interesting use case for this, and something I want to do after I have a few more years to build up my HSA, because there's something very attractive about using simple interest to reimburse myself for healthcare costs out of my HSA tax-free. So that's just one kind of creative angle for this here. So again, bad match. This is a bad tool to use in your after-tax brokerage account if you are a high income earner. It's a very good tool, however, if you have very little active income, and you're looking for some kind of paycheck that comes in, and you can actually keep yourself in a very low income tax bracket. It looks like we have a question here already.
Yeah, Noob, sorry, you were duplicated there. You want to ask?
Yeah, when they're paying you this current interest, simple interest on a monthly basis, where is that cash flow really coming from? So if you have a house that you're flipping, or you're doing some sort of big value add project, and you're not actively collecting kind of rent income, where does that cash actually come from to keep that in, the income flow to you current? It seems like you may be a better situated to more of like a payment in kind type of interest at the conclusion of the project, or what. Like if you look at the balance sheet of these loan companies, are they really paying you through, true net investment income, or is it coming from some other source and reserves or something like that?
It's typically coming from net investment income. And a new fund, I think your question is spot on. So if someone's spinning up something brand new, then the question is, hey, I'm putting all these loans in there. I'm wrapping the points and the interest into the back of the loan. How am I going to get paid? But when you have a pool of several hundred loans, that problem dissipates that you're worried about.
I also see a lot of these you have to pay as you go, Anoop. It's not always that way, but the vast majority, when you borrow the money, you're making a payment every single month, even though you don't have income coming in from the project and you're working on it.
Yep.
And there's also
And so
money from the
so
origination fee, right, up front, regardless of the ongoing.
No, that's typically not the case, I would say. I would say it's rare that the hard money lender will actually collect cash from borrower upfront. But yes, there's plenty of situations in this world where the borrower is paying a monthly fee in the interest, and there's also plenty of situations where the interest is wrapped and paid at the end.
So the borrower's not going to get paid once they kind of dispose of property. They do their some sort of release or to kind of sell to the next person, right? I mean, the
Yes.
flipper is doing the value add. The borrower is not going to create any sort of accretive value to it until the property is disposed. So again, it kind of begs the question, like, if you have 10 properties and 8 of them are still kind of getting refurbished or whatever, you know, where does the income come from for 8 of those 10 properties that you're getting paid? Unless it's just coming from the 9 and 10 properties that have to be sold, or else you have no current income.
This is like, so but let me be very clear. There is no free lunch. This is the Wild West, and there's a reason why you're getting this high yield. It's because of the risks that you're pointing out here. And I'm going to go into those for sure, right? But that's exactly right. This is going to go great until it doesn't in various markets, right? And so how do you mitigate that risk? Well, I'm going to talk about what those risks look like in there, and I'm also going to talk about how I think that I'm invested in a bunch of properties here in Denver, but let's say you're in Asheville, North Carolina. Well, and you're in one of these debt funds that's specific to that region. Well, you should be, first of all, if you're going to invest in this, you should be in a specific region, I believe. The operator should be, because they're going to have actual expertise in understanding underwriting ARV and meeting these people and sizing them up and using and passing judgment on their borrowers, right? A fund that has hundreds or thousands of loans across the country has no competence to bring to bear, in my opinion, on this subject. But a local operator will. But they also then subject you to things like hurricane risk, right? Or floodings that can destroy that whole area and cause problems, or just simple market contractions in there. And so you're absolutely right. When this pulls back, there will be pain in these debt funds, and there will be problems where people attempt to pull out their cash all at once and can't. These are highly liquid until they're not, right? So there is no free lunch in this space, and you're absolutely calling out good risks in there, and that's the challenge here, right? So my objective here is not to paint debt funds as some kind of panacea or free lunch. It's, hey, here's an opportunity. Let's go into it with a specific thesis that I'll argue for, and you guys can modify it or change it from there. Does that answer your question, Anoop?
He's
Yes, thank you. Appreciate it.
Absolutely. Um, I'll kind of skip through a couple of these. We talked about this a little bit here, what the project is, what the specific thing here, the specific underlying structure here is. We've kind of talked through what a flip looks like. I kind of previewed that already, but and I'll send this out for anybody. This is just a summary of a write-up I did using Notebook LLM here. Um, a reminder here that the borrower is not some professional in this space. This is an amateur flipper, usually not someone who's doing their first flip, but not somebody who's done several dozen or several hundred of them, because if it were, they'd be borrowing at a cheaper rate from a local bank, or they'll get preferential terms from a hard money lender. They won't be paying this 12 or 15% once they've scaled their business. So you're lending to borrowers who have run out of cheaper options. Doesn't mean that they're broke or have zero net worth. They are personally guaranteeing these projects typically, but you're working with somebody who's doing this on the side with their full-time job, or just getting into kind of full-time flipping in here. So that's a challenge in here that produces this risk. Again, this is why we're getting such high interest on these loans, right?
I want
Um,
to just, Scott, an important
but
thing to emphasize. Like when you think about you, me, or the people on the call as investors, we are vetting the lender. We're not vetting the flipper, which is a really
that's right.
important, I think. Like it's really important to understand what the lender is looking at and how they're underwriting. But that is the human being, the person, the GP, or however you want to call it, who we are vetting.
That's right. Yeah. Sorry, I'll spend less time on this here and flip through it because I get your point. But I've explained I over-explained now the unit economics of a flip, right? Here's the debt fund capital into a fix and flip deal, and here's the several hundred thousand of the flipper's equity. So the job of the lender is to generate this return with the least possible risk, right? So the lender kind of has a couple of options. One, they can sell this loan, or two, they can put it into a debt fund, as we covered here. I kind of skipped through a bunch of this when I was previewing a lot of this. We've talked about the options here for that fund. They can use 100% equity, which drastically reduces the risk of a debt fund. So if you're getting an 8% pref from a debt fund that uses no equity and that's it, that may not actually be a terrible deal there because if that debt fund has to foreclose on all of the properties, there's no timing risk. There may be losses that accrue. That's a drastically different risk profile than a debt fund that's a 50-50 levered debt fund, right? You can imagine that with a Noop's question, a couple of those projects go bad, we're running into problems real quick on the equity side of this debt fund stack here, right? So just something to think about there. That's the risk at the debt fund level. Um, let's talk about, the how if housing prices go down in a market, you're gonna see a ton of those projects, like kind of two, three, four, 5 out of 10 of these projects starting to float underwater and put a lot of pressure on these debt funds, right? So, 50% levered debt fund, in my opinion, requires you to get to that kind of 12% hurdle rate, in my opinion, over an unlevered debt fund. I would take an unlevered debt fund's 8% over an 11% return from a 50-50 levered fund. And then you can kind of use that as a framework to judge the relative structural leverage. Most people who are evaluating debt funds never ask this question. They don't even, it doesn't even occur to them that the debt fund is going to be levered against something else in this space. But I think it's really important. One other
Scott, one
caveat
thing I would
here.
say though, that with a debt fund that has some sort of line of credit, um, you know, it makes everything smoother because
That's the best
otherwise
practice.
there's absolutely a draw. There's a drag because you have to have funds that have come in that are sitting there that haven't been deployed, so you can fund deals. And then when people want their money out, you have to wait for something to pay off. And so a 50-50 can start to get risky, but I've actually seen from an investor standpoint, it's really a pain in the ass, and you really have a big drawdown in your cash drag if there's no leverage. So
I
a
completely
lighter
agree.
leverage fund would be something that I would say gets you in that sweet spot of making everything run smoother, where you can charge up that line and pay it back down and just make everything float easier.
Exactly. That's best practice. Like when I go through this later on, I'll say my favorite debt fund that is gonna be one of the categories is gonna be relatively low leverage with a line of credit that can flex for exactly the
Right.
reason you described there. Yep. All right.
The other
Let's
thing is
it,
that the line of credit gives you one more set of eyes looking at things. Oftentimes, if it's a big bank and a large line of credit, they're extremely good at the due diligence on looking at the loans themselves. And so it's just another set of professional eyes besides you as an LP investor.
exactly. And let's talk about what like good due diligence on the underlying loans look like here, right? So we've got a couple of things. We've got the borrower. What's their credit profile? What's their experience set? We've got the position of the debt. Some of these debt funds will put second position debt in there at 16 to 18 to 20%. That's an enormous red flag to me. Who's borrowing at 16 to 18% in second position from a debt fund of this type on their properties? I mean, that's not something I'm interested in. And if a significant percentage of the debt fund's assets are in second position, even if it's super high interest, very, very unappealing to me. I want them all in first position. The ARV is important, but I believe that one of the most important aspects of this is the regionality. I think that debt fund operators cannot operate across more than one, two, or three regions in a very comprehensive and sophisticated way. And that is the challenge for us as passive debt fund investors is to resolve that problem. So I'll kind of state it plainly here. I think that a debt fund cannot claim conservative underwriting, national scale, diversified loan portfolio across a national scale, zero leverage, and offer you double-digit returns. I do not think that is possible, and you should run away from that. So you must make a trade-off as you evaluate these things. What are you willing to take, and what are you not willing to take? I think that this is going to result in you getting scammed, or this is someone who doesn't know what they're doing, and it's gonna blow up in their face. So, Mike, do you agree with that statement?
Yeah, I would agree. It's not possible. One thing I would say though on the national scale is that it depends how big they are. You can't be a smaller player and get any sort of national scale. But I have seen some of the large, if you've got more than $1 billion out, you can start to get to where you've got boots on the ground in enough places that you can have that. And the risk with local, they know it well, but then you can end up if there's something that impacts that market, there can be a problem. So not to name names, but there was a debt fund that was highly concentrated in the Austin market that call it 3 months ago or so, did a 9% reduction of your capital just because they just did a write down. Not that there was anything wrong with that fund, and they're very experienced, but at the same time, they were over concentrated, and you had a 15 to 20% correction in that one market, and they were overexposed to just the Austin, Texas market.
Mike, you are the first person that I've come across in all these years that I think can actually go, have a good conversation about this topic with me in here with it. So I think you should be giving this presentation. I should be learning from you. I would love for you to keep chiming in with all these points here because it sounds like you've done as much or more research on this as I have on these debt funds here. But
Yeah, and well,
I would
and
push back and say that on that one national point that I would be skeptical of a national fund being able to deliver this without using a very irresponsible amount of leverage. And I would argue that there are significant that you have different risks there. And I'll just jump to the answer then on this. I think the answer is to go regionally and to invest in a concentrated pool of regional firms, but three to five, maybe up to seven of them, and spread that risk across those geographies so that when Austin blows up because it's a unique outlier, which you could never have predicted five. I mean, we could have predicted if we were smarter about supply dynamics and saw, hey, 10% supply coming on, rents are going down and property values are going down. Seems obvious in hindsight, but if you're not sure you can predict those types of things, going across five to seven different geographies and then investing with each operator will, I think, give you a better blend of risk versus reward than going with one national lender, where I think that's going to dilute that return profile for you. And or going with one operator, a smaller subset of operators where one geographic concentrated event can blow you up. So what's your opinion on that, Mike?
yeah, I would agree with that. And it depends on where you're putting this in your portfolio. I know a lot of people that look to products like this for the income portion. And I think if you are having a permanent income portion, then that's a great model to go with. I personally use this in my portfolio for my midterm money. I have my like 1 to 3 day money. I've got my 90-day money. I've got my annual money, and then I've got my long-term stuff. And I use this for that stuff that I don't know what I'm going to do with it for 6 months, but I probably am going to do something with it in the next 18. And so for me, I'm taking a little more risk by going with that national lender because I've got the 90-day liquidity versus most of the regionals I've found have like the annual lock or like a 1 year lockup. And they're also a lot of times going house by house, and you get where you're investing in just that versus I like to get to a bigger product to where you're actually in a fund, which a lot of the better regionals that I'm finding, they're still in that house to house. So I'm curious to see if you found some good options that way because I like what you're coming up with.
So, Mike, what I do with my, what I keep my permanent capital in these debt funds in my IRA, my solo 401k, right? That's that piece. And I will, once my HSA gets bigger, I probably need 5 or 10 years because of the limits there I will then begin putting that, I think, in some of these, or at least that's the tentative plan right now. When I need money for the shorter, the medium term, I actually buy, and it's a reasonable amount, I buy the note from the fund because then I can go to a property and say, great, if I have to foreclose and I own this property at this ARV after a painful foreclosure process, I'm fine with that. That reduces my risk. And because I'm comfortable with real estate, in my local market, I prefer that to having the money locked up in the midterm here because I fear the risk of redemption all at once as one of the risk profiles for this. So that's just my spin on your flavor of what you're doing with
Yeah.
this.
Well, and it sounds like you have the skill. You're in the Denver market. You sound like you have the skills to look at that and to know what the ARV really is and to be able to take over the project if you need to. I don't have those skills nor want to develop them. And so I don't have that ability to do that
Yeah, I
myself.
lived
But
in these
hold,
properties for 10 years, so I'm like,
Yeah.
okay, I can handle this over here. And it looks like you have another question here as well.
Yeah, so when I think about real estate debt funds, I kind of put into this broad category of, what I call or other people call asset-based lending, which is you're basically lending against to kind of hard collateral as opposed to doing, typical direct, lending based upon enterprise value and cash flows, which are no guarantee like we're seeing with the SaaSocalypse and so forth right now. So when you do real estate lending, as opposed to other forms of asset-based lending. One thing I like about ABL loans is that traditionally they self-amortize basically on day one. So you're being paid a current interest, but it's not IO and then a big balloon payment at the end. It's basically amortizing all the way throughout. So you're taking a lot of chips off the table, and it effectively lowers the duration of the loan, pound for pound compared to interest only. So I was curious if you had any funds that actually do amortization as opposed to simple interest with the balloon payment? And then the second question is, a lot of asset-based lending actually value the loan on liquidation value. So, if the loan doesn't perform and all of a sudden you have, this half-built piece of property or half-finished piece of whatever, it's, what can I actually get for it? Like, I'm not an operator. I don't own homes or flip homes. I don't deal with heavy equipment or whatever it is I'm leasing against. So if it's 60% on the dollar or, 70 cents on dollar of liquidation value, it's a much more conservative way to underwrite the LTV as opposed to just what the person says it's worth. And I was wondering whether you had any operators actually do a much more conservative loan to liquidation value metric as opposed to traditional kind of this is what we think it is valued at completion, but not in the middle of kind of a midst project that's not performing.
Sure. So these are great questions. The answer is I am building up kind of a playbook of what the industry looks like, and then I was going to build to fictional perfection, and then kind of describe, hey, the reality of the market doesn't work like that, though, right? The debt fund that is supposed to have 200 clean hard money loans of the same exact type in Denver actually has some exposure in Minnesota. Oh, in this office that's way over here because the guy knows him and trusts the guy there. And that's what the messy reality of a lot of these funds ends up looking like here. If you want that clean, pure structure, you go to different products. And then also in this category specifically, hard money kind of layering into and ramping into bridge debt. Bridge is basically hard money lending for larger projects, right? More commercial or industrial or institutional scale. A lot of these hard money funds will also kind of on those types of projects. The answer is no. Most of them are interest only in this world that I'm specifically covering on this. You can find plenty of debt funds that have other opportunities out there. But I have not done a significant amount of research or really have any depth on that topic at all.
And Anoop, it wouldn't make a difference anyhow. I mean, these are 6 month, 9 month loans, sometimes a year. The amount of principal pay down during that time frame would be, negligible, and no one does it. And as far as the more conservative, that's great. But the problem is that these borrowers are, they have lots of options. And so if you are attracting somebody like that, you're either going to have to be loaning at a much lower rate, or you're going to have to be taking on a much riskier borrower profile from their personal guarantees and other experience and things like that. So in reality, I would say no, no one has that. But that's where you want to make sure that the person making the loan has those connections or the ability to take it over themselves. And what some of them will do is they have so many connections, they just take it, it's 60% of the way done, and they have so many other flippers that they just flip it to them. And a lot of times it's just they're feeding it back in, or you want somebody that can take that project over and finish it from 60% to 100% and then sell it off. But that's more realistic in the real world of what you're getting and hoping for versus somebody giving a really low valuation of what it's really, would fire sale for.
Mhm.
I completely agree with that. That is where you're going to get the better risk-adjusted returns. And those people, I would argue, are points in time, many of them, right? It's not like that person exists for 30 years across a continuum. It's, oh, this person has just recently become, finished being a flipper and is starting to ramp their hard money portfolio. They have all the contractor relationships. They have all these other folks. They've made some wealth and they're building the fund. That's like that kind of that point in time person. Someone who's gone, what a big trap I've seen in this industry is over and over and over again. I could list 5 firms. I won't because this call is recorded. People have tried to buy up a lot of these products from across the country, and then those firms don't exist after a few years because the cycle crushes them or creates some sort of problem where they can't liquidate those portfolios or they're using leverage or whatever. And so that fast growth is definitely an issue in this space. You want a conservative quality growth, and that's why you're gonna have to go outbound to these people, right? Those people are not putting out major national marketing campaigns for LPs. They're steady, and they want people who are aligned with what their thought process is. And you're gonna have to go and find those types of operators and put together a playbook to get them. So basically, to kind of put a pin in it, I think the green flags here are exactly what Mike said. These are former flippers. These are people or lenders who have been in the space for so long that they know everybody. They know the new guy. They're willing to give out loans to a few new folks, but they also have these very long time repeat customers that have been in business for a very long period of time that are willing to take on those projects. They can literally go and take over the project themselves if they have to in many of these areas. I think that local fast foreclosure laws are really important in this business. There's a very different risk profile in Illinois than Texas. I'll also call out that California is not so bad in this particular field because the foreclosure laws are different around owner occupant versus investor properties in some of these categories. So that's something to think about as you look through these items here. I like this ballpark of 50 to 250 active loans. I think once you get way past that, it becomes very hard to manage, and there's systems and scale, and you're now having the judgment of a team rather than one or two individuals that bring a high degree of competence. I'm really not interested in second position. If there's a few second position loans, that's one thing, right? In practice, our fictional perfection does not exist. So if we get up to 3 to 5% second position because the guy is giving loans to people he trusts or whatever at various points, that's different than if you see 30% of the portfolio in second position, which is a huge red flag for me. And then light or zero fund level leverage, excluding the line of credit that we talked about here. A line of credit is almost a necessity for a professional credit fund like this because they need to be able to originate the next loan or cash out their investors. I like 75% or less of ARV. The lower that number, the better. That means all of the loans are more and more conservative. That's really hard for you to verify. So that's a big trust factor for the lender here. They need to have a process that they can explain to you about how they're determining that ARV and why that number is conservative or realistic in this place. So again, any significant second position loans, a massive amount of AUM on small notes. So that $1 billion fund you mentioned, Mike, if those loans are 2 to 5 million a pop, that's no big deal, right? That's a very reasonable fund structure. But if you've got $400,000 loans and you amass those into a $1 billion portfolio, that's a complex mess. Somebody's gonna have to clean up, probably at your expense, in my opinion. I don't know if you agree, but that's my view on it.
Yeah,
Long,
and a lot of times when they get bigger like that, that's one of the risks. They start getting into bigger loans, and that's where when you're looking at this, you need to make sure that the what you're investing in is what you want. Because I've seen some morph from the average loan tape is 250 to 400,000 for single family homes, and then a few years later, as they grow, they're doing more $10 million loans, even every now and then a $50 million loan, and that's not necessarily bad, good or bad, but it's a different risk profile. And then with the ARV, the biggest thing I've seen there, and Scott, I'm curious if you found a way to check this, but you get some people that say, "Oh, we only loan, like 70, 75% ARV, that kind of thing." But at the same time, their ARV is higher than reality. And
that's it,
so
right?
it's like, and unless you can get somebody that tells you what the real value was versus what the their on books ARV is, if that number is inflated, it can end up looking like you're in a really safe fund, but you're really not. And so another thing to look at is loan to cost. And if they won't give you loan to cost, that's something that I would be nervous with. But I don't like going into anything that's more than 90% loan to cost. So you've got actually 10%, there that they're putting in, because sometimes you can do a 70, 75% ARV and the person does not have to put in any real money, that there's enough, value creation through what they're doing that they think that they don't have to put anything in. And not necessarily that that's wrong, but you are at more risk then if they have no money in.
I completely agree. And a good operator, when you go and get the prospectus, will show you both of those metrics, ARV, their loan to ARV and their loan to cost in there. And I think that 10% spread is a perfect number there because you probably have a good shot at getting your money back in a foreclosure process. If you had to foreclose immediately or within, without a big market crash in that instance, if the borrower really laid an egg. So I think that's great. Great build. Um, so that this comes back to my thesis here, which Mike, you forced me to present earlier here. But basically, I think the answer is if you're going to do this, go across 5 to 7 different geographies that are totally unrelated to one another, and do that diversification, diversify geographically yourself. Don't look for the operator that is doing this for you because they almost certainly will not be able to bring that competence to bear on that. And this is an interview process that you'll conduct with this portion of the portfolio here. And I think that capital would look like 25 to 100 or whatever that percentage, whatever amount you're thinking about deploying in here. For me, it would look something like this kind of 50 to 100K mark allocation across several different of these geographies.
Yeah,
So
the biggest question is finding operators in each of those geographies, right? That's seems like the biggest hurdle across this
that's right.
whole asset class.
So the best approach there is to go to a place like Scotsman Guide or BiggerPockets and look at the hard money lenders who are soliciting for borrowers and start making phone calls. Ask them for the prospectus. They'll send you the prospectus. About half of them will have a fund that they back up to, or be able to refer you to somebody that does. The other half are selling the loans, or have a closed fund that's just their own personal capital as you go about doing this. So that's basically the presentation for this debt fund topic. I think the thesis is this is a great place. This is a place where there's real risk-adjusted return for you to go and pursue. It's not very tax advantaged, so it's got to be done in a taxable account or got to be done as a part of a broader tax strategy. There's real alpha in this world that I believe is going to be brought to bear by skilled operators with backgrounds in real estate investing and flipping, or deep experience in the lending space over a very long period of time, and an embedded network in these geographies. And there's a sweet spot for these funds in, 50 to 250 of these loans, reasonable, hopefully light fund leverage. And if you do it right, you should get an 8% pref plus a few more points of profit share beyond that, with these funds. And there's a real place for that in a good number of portfolios in the space here. And so what I would argue for you guys is have that kind of thesis when you go into any investment here, right? The other alternative I was going to present today was office. We're definitely not going to get to that. But that's an equity side component one. And it's basically, hey, office buildings are so depressed. There's actually a Wall Street Journal article about this that kind of ruined this point earlier this week. But office prices are so depressed that if you buy them with all cash and hold them for 10 years, and fill them back up slowly, and sell them at a 10 or even 12 cap, you're probably going to make a huge IRR. And that number only explodes further if you layer in debt once you do have net operating income to borrow against on those purchases. So there's a whole
We'll
deck
do
behind
that.
that. I
We'll
present
do that
that
on.
for another time. I'll
I
send it
think.
out if you guys are
Yeah.
interested
I,
in
I, I
flipping.
think Scott. I think if you're open for, we'll probably do another one of these calls and focus on office. Because this was super interesting. If you guys have any questions, feel free to put in the chat or just unmute yourself. I mean, I thought this
So
was a super interesting
one
conversation.
comment I was going to say is if you're putting these into a tax advantage fund like Scott recommends, it doesn't matter. But if you're in a taxable account, there are some of these medium to larger size ones that have a REIT structure, which then currently you're getting a 20% reduction in your taxes on that. So those may be worth seeking out from because you can likely have a higher tax after tax return if they're in a taxable account.
Great point, Mike.
And I haven't seen any of the smaller ones do that. I think you have to get to medium sized to large because there's such a hassle and cost to putting that REIT structure in place.
By the way, if we have anyone here on the call who's invested in debt funds, we'd love to hear sort of also your input, your experience with this. If you guys agree or disagree with all this, also be great to hear. Or no one. I have a question, sort of maybe Mike to you, because you like there are other more national debt funds, which I think you do like. Where would you put the threshold between the large operator, like the ones you like, and the operator that Scott is talking about? Is it just the geographical focus, or is it something else?
I think I don't know. I mean, it's pros and cons with all of it. And I think it's just what you're comfortable with. I mean, I know guys that are very sophisticated that they really prefer the funds where they're investing in one house at a time because they can kind of come along and help underwrite that specific home that they are investing in. I don't have those skills. And so I stay away from those. I want the diversification and I just want to go with who's smarter that way. And then the same thing, I think if you're doing this multi-pronged approach like Scott's talking about, that's a great way to have of somebody that's really strong in an area, but you're not overexposed to it. I haven't done it just because, again, I'm not using it in my portfolio for real long-term money. My real long-term money like that, I'm able to find some funds out there that are paying in the 9.5%, cash, and I'm also getting some equity upside on it, but it's long-term money. I'm putting it in for 5 years, 10 years, that kind of thing. And so when I get into that longer term stuff, that's what I'm looking for is those high cash flowing real estate investments that are going to be super long term. And this stuff I use as sort of my liquidity slash cash flow. But I
Yeah, but
know a lot of smart guys build their
but you,
portfolios around this stuff all the time.
but I think you just gave two examples of the edge cases. Like if I'm lending money to a lender who's doing one single deal. That's not a fund, right? I'm basically participating in the hard money loan directly.
Right. Yep.
That's totally different than if
And
I'm
there's guys
a
that like
diverse.
that because
Yeah,
what they
but
can do is they can come along and underwrite that house themselves and feel like they believe in that project and they're getting it to where if they and the rest of the people in that specific loan have to take it over, that they're okay. Because Scott, I heard you saying kind of like that. You're buying the note in a specific home. And again, you feel comfortable in the Denver market that you're like, hey, if I have to take this over at this basis, I'm fine with it.
That's right. But then I have like $800,000 in this one loan, basically. I don't want to share it with somebody else. Then that defeats that defeats the risk profile, risk profile for me. And then, so I actually did that with several of these loans and kept rolling them with the same borrower, right? So they would finish the project, sell it, then get a new note for the next project, basically. But then I have to redo my diligence, and I might have liked project one and been, I don't know if I love project two, but I gotta, so that's why I got out of that. It's just a lot of it. There's real work, and you have to really turn your brain on every 6 to 9 months, depending on how that process goes.
I don't know if
yeah,
you can hear me, but I had a question regarding like funds that have both. Basically, a sponsor's got two different arms. Like one could be a debt fund, and the other can be a capital fund that does more of the equity side. And they could kind of be on both sides of the same property. So if you're in a debt fund that's an evergreen structure, it's got 20 different assets in there, and the properties are having issues, and even though loans look current, the properties could be issuing kind of pref equity raises on the other side. It looks good on paper because your interest is current. There's no defaults or anything like that, but clearly there's more kind of stirring up of water underneath there's more current in the water. You just don't realize it. So when you have evergreen funds, I think like DLP is one of them where you have both a capital fund and you have a debt fund. How do you really realize like what their sponsor is doing at the property level in terms of being on both sides of the cap stack, and kind of be benefiting potentially from both, where investors are really not sure what's happening at both sides of the equation. If that makes sense.
When I was the CEO of BiggerPockets, I did not have other people's money that I was managing and investing. I worked 60, 70, 80 hours a week on BiggerPockets. I managed it. I had most of my wealth in BiggerPockets. That's what a fund manager should do, I think, in my opinion. I cannot stand these people who have seven, eight, nine, 10 funds and are doing all these different types of things, and I won't touch them. I won't give them my money, right? So if I'm going to invest in something like this, what I'm looking for is I'm looking for somebody with a debt fund and a hard money lending business. Those two go together and make sense, and that's their job. And that's what they've done for a while, and that's what they're going to continue to do for a while. And I'm out with these guys that got six different funds going on and claim victory over here, while their real trick is turning $1 billion into 700 million. So that's my spot on that particular point. I don't know if that answers your question, Anoop, but you triggered me. I don't like that at all.
No, I don't like it either. But I see a lot of people falling for that, and they feel relatively good about their debt fund. Where on the equity side, things don't really look good, and it's the same properties that are on both sides of the fund. So it kind of makes things look good when they're really not.
I'm not giving the operator a free spin. It's like it's an opportunity cost for you. You're going to spend the next several years managing this pool of capital, and if it doesn't work, it's going to be a real loss for you. If it does, you're going to buy your mountain house after you return my money. That's my point on that. So not very popular take with some of the people
no,
that
I
have
think it
very
is. I
large
think we
Instagram
thought
followers.
we talk about we talk about it a lot actually. Like you think about GPs, there's like a huge spectrum of GPs. There's first time GPs, emerging GPs, medium. There's the Blackstones of the world, the Apollos. Like there's a whole spectrum of people you can invest with, and each of them comes with a different risk reward profile. And obviously, the larger you go, you have those risks as well, but you also have lower risk in other aspects of it. So I don't know if this is like a right or wrong. It's an approach. I agree with your approach, by the way, personally. I'm just saying people who might want to invest with the big guys, it's not that it's bad. It's just a different risk reward type profile. Do
I don't have a problem investing with the big guys, right? Necessarily. It's just I have a problem investing with the guy with 8 funds who's also talking about how wonderful their lifestyle is and how they spend 1 hour a week on their business. Like that really gets me.
Okay, yeah. Well, you're
Blood
right.
boiling.
I agree with that 100%. Right. Yeah, fair enough.
Yeah.
Well,
I don't
especially
think
if one of
yeah.
the if some of those funds aren't going well and they're still advertising how they work 5 hours a week and a bunch of money that they've raised isn't going well and LPs are losing money and they're still living a great lifestyle. That's frustrating to
Yeah.
I,
watch.
we had a problem a while back on Bigger Pockets where these guys would they like this guy posted, "Hey, anyone heard what happened to this property?" And this the syndicator apparently told him, um, or it was, "Hey, this got foreclosed," and then there was a threat from the GP, and it's kind of like this weird first world problem because the LP is still a multimillionaire, right? These are not like helpless people that are, no one on this call is a helpless, person that doesn't have some resources and basic skill and capacity to get to the point where you can plop 50, 100, whatever the minimums are in these funds. But there's also a huge power dynamic between the syndicator and the LP because the syndicator is many, many times wealthier, very powerful, has a very large ego in most cases because they think they can win. And there, as they should. You shouldn't be investing with somebody who doesn't think they can win to a certain degree or competently manage their business. But this person basically threatens them and says, "Hey, take this down or I'm going to sue you." And so my only response to that was basically, if you sue somebody on Bigger Pockets for accusing you, I'm not going to pass judgment. I don't know who's going to be right or who's going to be wrong, but I'm going to cover it. It's going to be front page in all of our podcast. It's going to be covered on our podcast. It's going to be covered in our blog. It's going to be covered through to conclusion. And if the judge rules against you, then we're going to publish the returns of your profile with a third party journalist from start to finish, and that shut it up for us pretty good on there. But I think that that's the challenge here. So this area is a challenge for me because it got out of hand over there. And some of those guys got big on Bigger Pockets or from the podcast or whatever in there. And so I feel an accountability to the space as well as part of that. You couldn't know who was going to win or lose at the beginning. You certainly can see who should be getting the second chance now and who shouldn't. And I think that's another interesting part about all this, right? Is why did somebody lose over the last 5 years, right? Was it, an office operator who lost their shirt because they bought in 2018 or 2019 is fundamentally different from somebody buying multifamily at a three cap at the peak, right? How could you possibly have known that office was going to get clobbered by COVID or just going to fundamentally reset hybrid work for the next decade in there? That person may be a quality operator to invest with again. Somebody who put all the chips into the table at one point in a scattered, strategy free, as I like to call it, portfolio across multiple different property types and multiple different regions all at the peak. That's a very different profile that I find very distasteful. So,
Yeah. This has been awesome, Scott. So we're gonna wrap up. We're gonna share, if it's okay with you, the presentation.
mhm.
And I also have the other thesis you share with me. If you're cool, we can share that, or we can wait for another call we do around office.
Yeah, that thesis is here. That thesis is there. And then I also, if you want to check out the Passive Pockets podcast, I covered that in pretty great detail with Ash Patel, who's a well-known office investor. He disagreed with my thesis. He agreed largely with my hey, office is an opportunity, but he said no, go suburban. Whereas my thesis was more, I like the urban stuff that's vacant and on its deathbed, basically, because you can buy it so cheap and fill it back up. He's like, nah, suburban's got much safer. Um, but it has some income and net operating income that allows us to value the business and borrow against it, or value the asset and borrow against it. That makes it a much better risk return profile. So that was an interesting one. If you want to check that out, it's on the Passive Pockets podcast, and I'll send the deck out that I have there. Or you can. You
Yeah.
can.
So I'm gonna share the recording and Scott's info and all those materials. Scott, this has been amazing. I really appreciate you for coming on. Thank you all for joining as well. Mike, as usual, awesome questions. I'm glad you're here with me because you're much smarter than I am, and I love it.
If I could
And
only figure
until
out how to get into the call on time.
Yeah.
If
Yeah, my email, by the way, is scott@biggerpocketsmoney.com. And I'd love to connect with anybody, but Mike, I'd particularly love to connect with you if you have a chance. I really learned a lot from you today on this.
Oh, sure. Thanks, Scott. Appreciate it.
Awesome. Well, everyone, have a great rest of your week and keep investing smart. Bye.
Bye, guys.